Hi everyone and welcome. I'm Christina Pumbakian, and if you are one of those home buyers who has been waiting on the sidelines for interest rates to drop before jumping back into the housing market, this video is for you, so tune in. I have my special guest today, my good friend and most trusted lender, Sarah Mars-Batuni from Premier Plus Lending. Hi Sarah, thanks
Hello.
for joining me again.
Thank you, thanks for having me.
I'm
It's
so
always a
excited.
pleasure.
Thank you. So sorry, I didn't mean to talk over you. I'm just so excited about what we're going to be talking about today, because as interest rates have gone up from the unicorn rates that we saw, the sub 3% interest rates, it has put such a damper on some home buyers' souls that, and I'm not even trying to be dramatic about it, some people are just so extremely downtrodden over how rates have increased from the sub 3% that buyers are actually waiting on the sidelines, hoping and praying for interest rates to drop so that they can get into a position where they feel that they can go buy that home that they were so hoping to get last year. So what we're going to be talking about today is a really incredible solution. We're going to talk about a permanent solution and a temporary solution to the higher interest rate problem. So take notes because we're going to dive right in. So let's talk about the interest rate buy down. Okay, how is this a solution that is going to help affordability for the prospective home buyer, both in a short-term situation and permanently over the long term? Let's talk about the mechanics of it, what it is, and ultimately how much money it could save a buyer.
Yeah, thank you. Thanks for having me. It's amazing to be here. And there's great ways to get into a property today versus like waiting for the rates to go down. And the two ways you could get a much lower rate is to get either a temporary buy down or a permanent buy down. And we'll kind of go over the details what the two are and how they're different.
Great.
So temporary buy down drop your rate a lot more, and it's only usually for 3, 2, or 1 year.
Okay.
So there's different kinds of buy downs. A permanent buy down is someone paying discount points. So you pay a one-time fee to permanently have your rate lower. Those are the two differences between the temporary and long-term.
Okay, great. So let's focus on the temporary for now, okay? Let's say a home buyer, they've been pre-approved, they're ready to go, they find the home that they love and they're ready to write an offer. They're just feeling like the interest rate is a little too high for their comfort. And one of the options that we give them is a temporary buy down of the rate, okay?
Yeah.
So let's talk about that. Who pays for the buy down? At what point does it come into play? How much can the rate be reduced? So go for it.
Okay, so there's a few different temporary buy downs. We have what's called 3-2-1 buy down, 2-1 buy down, there's 1-1 and 1-0. So actually 4 different kinds of buy downs.
Okay.
Probably the most popular one, and that's the one we'll talk about, is the 2-1 buy down.
Okay.
Which means your interest rate goes down for 2 years by 2 points year 1, by 1 point year 2, and then goes to your normal rate, and it'll continue that way for the rest of the term as long as you keep that loan. Now, the reason that temporary buy downs are so popular now, and this is how buyers are actually getting into properties, is because sellers are willing to give concession so the interest rates could be lower by 2 points and then by 1 point. So basically that credit that you get from the seller subsidizes your payment for the first 2 years of the loan. So for example, I wanted to give you like a quick example, like on a $800,000 loan, and let's say your starting rate is 7%, year 1 your rate will be 5%, year 2 it'll be 6%. So year 1 you're saving about $1,000 on your monthly payments.
That's
and
amazing.
then and year 2 your payments will be $500 cheaper, and then by year 3 most likely the rates will come down and you could refinance to permanently having a lower rate. And that cost for that buy down comes from the seller concession.
Got it. And then, so you just mentioned the 2-1 buy down, but to kind of delve into the mechanics a little bit more, let's use another example, like the 3-2-1 buy down is 3 points reduction year 1, 2 points reduction year 2, 1 point reduction year 3.
Exactly.
Okay.
So like if your starting rate was 7%, year 1 your rate would be 4, year 2 would be 5, year 3 would be 6, and then year 4 it would go into your regular rate, which would be 7, for example.
Right. Now, at what point in time can a buyer who has utilized this temporary buy down end up refinancing to permanent financing? Is there a time period that they have to wait in order to refinance?
No, actually, there's no time period. They could refinance a year later. If the rates go to like 5% in 1 year, they could refinance in 1 year. Now, with that additional funds that they got from the seller, you don't lose that either. That money gets deposited into an impound account. And let's say you still have like 10,000 left after year 1, that money gets applied as a principal reduction. So there's no like downside in getting this.
That's amazing.
Yeah.
Yeah.
And I think a lot of times, and maybe this is something you could touch up on, if you have a property that's been on the market for a long time and it's not selling, these may be the right properties to go after and get these seller concessions.
Exactly. I'm really glad you brought that up because we're really in such a unique market, for the interest rates having risen as much as they have in comparison to what they were a couple of years ago. The market hasn't really stalled, at least here in Los Angeles. I am still seeing homes, some of my own listings, going with multiple offers well over list price, okay? Now, that's not the norm. There are certainly some homes that have been sitting on the market. They're becoming market worn. They're getting stale. So the key really from a seller's perspective is always price your home attractively so that you can capitalize on the demand that's in the market in the moment and really maximize your sale price, okay? And so for those sellers who have done that, who've priced attractively in comparison to the comps, those homes are still going with multiple offers well over asking. There's a lot of competition. So in a situation like that, where you have one seller and 10 buyers, for example, competing for this one property, going in as a buyer and making a request for the seller to credit you to buy down your rate is likely not going to make you a competitive purchaser when you may have other buyers coming in bidding above list price, significantly above list price, perhaps coming in all cash, not asking for any credits. But to the point that you brought up, we are seeing a lot of price reductions. We are seeing a lot of expired listings. We are seeing a lot of properties just sitting on the market for months at a time. And those sellers may not quite be at the mental readiness yet to make that price reduction. Each seller has their own motivation when it comes to selling property. It could be a financial motivation. It could be an emotional motivation. It could be familial motivation, employment. There's so many different factors. And if you do find a home that you love as a buyer that's been sitting on the market and you're questioning, it's a little over my budget or it's right at the top end of my budget. I don't really know if I could afford this price point with the interest rates being what they are. My suggestion to my buyer clients out there is if you don't try, you're never going to get it anyway. So why not try in a creative manner to see if we can get the seller in communication and get them to buy your rate down. At the end of the day, they're on the market because they want to sell their home. They're not just testing the market. This is not the market to test when you're listing your home, okay? Don't test the market now. It's not the time for that. So there is some motivation for them to sell. So coming in with an offer where you're showing your proof of funds, you're showing that you're approved for a loan by a reputable lender, and you're saying, hey, I can close at this purchase price if you can help me achieve this rate, it becomes a win-win for both the buyer and the seller.
Absolutely.
So this is certainly not a fix-all situation, but it is an incredible tool to use that could be a win for both the buyer and the seller in certain situations. And I have used it successfully in my own negotiations for my buyers. So it's really powerful.
I think recently I read statistics that 30% of the transactions now have some kind of a seller concession.
Yeah, it's not surprising.
Yeah.
It's not surprising. I mean, concessions can come in various forms, including not just for buy downs, but also after inspections. The buyer may find that there's something, a surprise really, and not a good surprise with the property. That we like good surprises, not the bad ones. But that's another scenario in which seller credits may come into play. And part of my job as your real estate broker is to help you put these puzzle pieces together, and in conjunction with your lender, decide, okay, how is this credit going to best serve the buyer?
Yeah.
Are you better off taking a price reduction, just directly $30,000 off of the ultimate purchase price? Are you better having the seller credit you towards your closing costs so you come out with less cash out of pocket?
Yeah.
Are you better off financially by having the seller buy down your rate? So there's a lot of strategy that goes into this, which is why the collaboration between the buyer, the broker, and the lender is really essential. And also on the listing agent side, the communication about the motivation of the seller and the motivation of the buyer, bringing them together for a mutual win is so key. And this buy down has really been a wonderful way to accomplish that, especially this year, as we've been seeing rates doing what they've been doing.
Yeah, and Christina, you're so amazing with your clients and on your communication and trying to get them the best deal possible. It's amazing.
Thank you. I try. It's just all about really understanding what the needs are and just delivering on that in the best way that you can.
You always go above and beyond for every client.
I appreciate that. Thank you so much. So in terms of the temporary buy downs, different ways of being able to negotiate that could be in your offer, right? If you are, I think it's important to talk about when you can kind of make this request, right? So if you're not really up against any sort of competition, if the home has been on the market for quite some time, seller's hearing crickets, there's nobody out there writing offers, and you decide that you're going to put an offer, one option may be for you in your offer to request that this become a term, that the seller agree to it up front, right? And that is certainly one way to negotiate this. The other option would be if the buy down was something that you weren't necessarily thinking of doing to begin with, but certain issues came up during the investigation period that were previously unknown to you, and now you're calculating the math that, okay, I found out that X, Y, and Z are issues with the property that I didn't previously know, that weren't previously disclosed. I know this is going to cost me more money out of pocket to repair these items or to address these items down the road. Instead of just walking away from the deal and canceling escrow, let's think of another solution.
Absolutely.
And so as long as your contingency periods are in place, you might be able to negotiate a seller credit in the form of a buy down or some other financial structure like we had previously touched on that could be of benefit to you. So instead of walking away from the deal, you can keep it together and move on. Is there anything about the temporary buy down that we haven't really discussed? Or was that pretty comprehensive
I
what
think
we've
that
done?
pretty much covers it.
Okay.
Again, the reason I said 2-1 is the most popular because the amount of the concession from the seller is more reasonable. That's why it is more popular in comparison to 3-1. However, we've done both. We've done 3-1 and we have done 2-1. And typically, like if your starting rate is, let's say, 6.875 on a 3-1 buy down, your year one, your rate would be like 3.875.
Yeah.
So you can actually see rates in threes if you decide to exercise this option.
Right. So let's talk about the permanent buy down now, because this is another solution, whereas the temporary is going to help you out for 1, 2, or possibly 3 years, and then you will be dealing with an adjustment of the mortgage rate. The permanent buy down is another option where the rates are what they are today. Let's say they're 7.5, and you decide that you don't want to go to the seller to negotiate them buying down your rate. You would rather pay points
Mm-hmm.
to permanently reduce that rate. So people hear points all the time, 0 points, 1 point.
Yeah.
Let's talk about points. Let's make sense of what points are and put it in a context of why should somebody even consider paying points? I mean, they're like, I'm already buying a house. I'm paying a lot of money to buy a house.
Yeah,
Why do I
yeah.
want to pay points?
Yeah. So basically, permanent buy downs is paying a one-time fee. It's called usually discount points. So you may be paying a 1% discount point to get like 0.5% reduction of the rate. So let's say your rate was 7, now you'll be at 6.5, but it's going to cost you an upfront fee. And that 1% is 1% of your loan amount. So if you're getting a $500,000 loan, 1% is $5,000. If you're getting a $1 million loan, 1% is $10,000. So I think it's important, it ultimately comes down to the client, right? What's more important to them? To have more money in the pocket up front, or to have a lower payment for the rest of the term? Statistically speaking, most people do financial transaction within 5 to 7 years of buying a property, whether that's like refinancing to lower the rate, cashing out to fix the roof, or life circumstances happen. Their kids go to college, they get married, and they need money, and they may cash out and refinance and cash out and pull money. So statistically speaking, I always say, like, let's compare if you didn't pay points versus if you did pay points. And you have some kind of a break-even point. How many years is it going to take you to recoup that, $5,000 that you spend up front? And general rule of thumb in the past has always been, if you could recoup the money within 5 years, it's worth paying the cost. In today's environment, when the rates are more volatile and we have all these like news coming out, the Feds came out with news that they're going to lower the rate. Fannie Freddie came out with news that the rates are going to go down. So knowing that, obviously no one has the crystal ball, right. We don't know what's going to happen. But generally speaking, that's kind of like consensus that the rates are going to come down. So is it worth paying points if your break even is 5 years? Maybe not. It may be worth paying points if your break even is now 2 or 3 years, because the chances of you refinancing are going to be a lot higher in today's environment than people who were getting 2 or 3%.
Right, of course.
Yeah.
I'd like to touch on an important distinction between temporary and permanent, besides the obvious that one is temporary and one is permanent, is who pays for this reduction of the interest rate. In the temporary, you're oftentimes asking the seller to pay for some sort of a credit. For the permanent buy down, it is the buyer that needs to pay the discount points, correct?
Well, during the temporary, yes, it has to be seller concession. The client themselves cannot contribute to that, because it's like, if you have the money to do that, you might as well pay the higher payments. It doesn't make sense. But with the permanent buy down, it could be either or. So if the buyer chooses to pay for it, they can. If you're getting a seller concession, that could be applied towards that cost.
Oh, got it. Okay.
So either one would work.
Great.
During the permanent buy down.
Oh, good. So there's some flexibility there
Yeah.
in terms of who pays for what on the permanent buy down.
Yes.
Amazing. I'm so glad that we're sharing this information, because just from my own clients that I work with, there are a lot of people who have, like I said, just kind of been discouraged that rates are so high. And let's also put it in perspective. Yes, rates are no longer the sub 3%. I call those like the unicorn years. We're probably not going to see those again in our lifetime. But back many years ago, rates were actually much higher than 7%, even 8%. Can you give us a little bit of like historical snapshot of, what rates were, back, say, like in the 2000s or in the 90s in comparison to the 7.5% ballpark rate that we've been seeing?
I've been in the industry for about like 20 years, and we at that time when I was doing loans, the rates were 8-7%. And then during the 2008 market crash, the rates did go down. After that, for a few years, we were in the 4s and 3s. And then they kind of gradually went up to like 4.5-5%, like normal market, until COVID. And then during COVID is where we saw this, like extremely low interest rates that I don't know what the chances are of us seeing that ever again,
Right.
you know. So historically speaking, these are not high interest rates, but the home prices, the argument to that is that home prices back then when the rates were high were like $100,000. So the affordability becomes like a huge component in today's market, and banks are trying to come up with creative ways to make it more affordable and coming up with this buy down program that, could still today offer you a rate in 3s or 4s or 5s, if you choose to exercise it.
Right. One of the things that I like to guide my clients on is that, making a home purchase or any property purchase it is very much a financial decision as much as it is also an emotional decision for a lot of people. You hear about somebody falling in love with the home, and you just feel it when you walk in through the door, and that's fine and great, and I want every single one of my clients to be in love with the home that they're buying. I don't want anybody to buy a home that they're not thrilled about. And that being said, that emotional decision needs to be supported by solid financial underwriting and backing and just good decision making. So in addition to talking to you or your lender, oftentimes I also recommend, talk to your CPA, talk to your financial advisor, like build this team around you of people who are fiduciaries, who have your best interest at heart, who can really look at your entire financial situation and give you guidance as to what the best course of action is for you moving forward. So I do want to touch on that point, because decision making and buying and selling property is never just single faceted. It's not just like one dimensional. There are so many different moving parts to it that need to be taken into consideration. So that is one point that I want to drive home. Thank you so much for shedding light on this buy down, both the temporary and the permanent. I know it has been such a valuable tool for my clients to use. I hope for those of you listening who've just kind of been waiting and looking online at these homes popping up and just praying for interest rates to come down. What goes up must come down and vice versa. Nothing stays stagnant forever. There's always change in the marketplace, and you don't necessarily have to just be a passive bystander waiting for rates to come down. I do want you to know that you are empowered by certain programs that are available to you today. If you consult with your real estate broker, if you have a great team around you to help you think outside of the box and explore these different options that could put buying power right back into your pocket in a time where most people are waiting on the sidelines. With rates just having been reduced 3/4 of a point, loan applications went up 20%.
Yes.
Listen to this again, a 3/4 of a point drop in the interest rate increased loan applications by 20%, okay? What do you think is going to happen when rates start coming down again? How many more buyers are you going to be up against, competing against, once rates go down? Why not you try to reduce the rate yourself? Right? With this buy down program, whether you're paying for it out of pocket or whether the seller is contributing to it. So if home ownership is a goal of yours and you're really serious about it, I don't recommend sitting on the sidelines just waiting for the right opportunity. We can create opportunities for you. Please feel free to reach out to us if you have any questions about home buying and how to strategize. We're here for you. Sarah, thank you so much again. You're such a valuable resource to me and my clients. I can't thank you enough for being here, sharing this wealth of information. And thank you all for tuning in. Until next time, take care. Talk to you soon.